Have you ever wondered why most traders fail, while a select few amass fortunes that change their lives forever? What if everything you've been taught about trading is not just wrong, but the exact opposite of what truly works? The conventional wisdom tells us to buy low, sell high. It's repeated so often that it's become gospel. But what if I told you that the greatest market speculator in history built his fortune using a completely different approach? Jesse Livermore, the legendary trader, who made the equivalent of billions in today's money, operated on a principle that seems almost heretical to the average investor: buy high and sell higher still. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. Has this ever happened to you? You see a stock breaking out to new highs, and something inside you screams, "It's too expensive now, I've missed the boat." That hesitation, that reluctance to buy strength, might be the single biggest obstacle between you and trading success. The amateur mind is conditioned to hunt for bargains. We're trained from childhood to seek the sale, to find the discount, to never pay full price. It's in our DNA as consumers. But in the market, this instinct is often deadly. The professional speculator understands that price is not the same as value. The stock making new highs isn't expensive. It's strong, and strength begets strength. Stay with me until the end of this video, because what you're about to discover might completely transform how you approach the markets. Livermore wasn't a bargain hunter prowling for deals in the discount bin. He was a connoisseur of strength. A man who recognized that the most powerful force in the market is momentum already in motion. Think of it this way. When you're standing at the train station, do you try to jump on the train that's barely moving, or the one that's already demonstrated it has the power and direction to reach its destination? The master speculator chooses the latter every time. This strategy of reinforcing success, of adding to winning positions rather than averaging down on losers, is completely alien to the amateur mind. It requires a fundamental rewiring of how you think about risk and opportunity. It demands the courage to buy when others see danger, to add when others take profits, and to recognize that the new high is not the top, but often just the beginning. What you're about to learn in this video is not just another trading tactic, but a complete philosophy of market operations. It's the scientific process by which small, correct judgments are transformed into life-altering fortunes. And it begins with understanding why the stock breaking out to new highs might be the very one you should be buying, not avoiding. If you've found value in these trading insights, hit that subscribe button to join our community of serious traders who are mastering the art of market speculation. The transformation in your trading results begins the moment you embrace this profound market truth. The greatest fortunes aren't made through sporadic trades or lucky guesses. They're built through a deliberate scientific process designed to capture the major movements of the market, what Livermore called the primary swings. These primary swings are the massive, sustained trends that carry stocks upward for months or even years. They're the hidden rivers of money flowing through the market, invisible to those distracted by the daily noise and volatility. While amateurs exhaust themselves chasing quick profits in the choppy waters of day-to-day price action, the professional patiently positions himself to ride these powerful currents. This journey requires a complete mental shift. It's not enough to simply buy a stock and hope it goes up. You need both offensive and defensive tactics working in perfect harmony. Think of it as a military campaign. You don't just charge blindly into battle. You probe, you advance strategically, and you always have a plan for retreat if conditions change. The revelation that changed my own trading forever was understanding the true meaning of a new high. When a stock breaks above its previous high point, something profound is happening behind the scenes. This isn't just a number on a chart. It's telling you a story about the balance of power between buyers and sellers. A new high means every single person who bought this stock at any price in its history could now sell for a profit. Yet despite this, buying pressure still exceeds selling pressure. Think about the implications of that fact. All potential sellers have been absorbed, and still demand outstrips supply. This is unassailable strength, the clearest signal the market can give you that the path of least resistance is upward. The amateur looks at a stock making new highs and sees danger. It's too expensive, they think. It must be ready to fall. This mindset comes from our everyday experiences as consumers. We're trained to avoid paying premium prices, to wait for sales, to hunt for bargains. But the market operates on different principles than the shopping mall. The professional sees that same new high as the beginning, not the end. It's the market's own declaration that something powerful is happening. It's the sound of the starting gun for what could become a major move. The wisdom lies in recognizing this moment of emergence, when a stock breaks free from its past constraints and moves into open air. This mindset shift doesn't happen overnight. It requires deliberate practice to override your natural instincts. Your brain will scream at you not to buy that stock at its highest price ever, but consider this. Every stock that ever made a 1,000% gain had to first make a new high, and then another, and another after that. Each new high wasn't the end, it was merely another beginning. Now, I want to go even deeper into how Livermore actually implemented this strategy in his trading campaigns, because understanding the principle is one thing, but knowing exactly how to execute it is where the real impact happens. Write in the comments, new highs, new beginnings, if this perspective is already shifting how you view price action. The hidden truth that separates master traders from everyone else is their willingness to overcome one of our deepest psychological biases. From childhood, we're programmed to seek bargains, to wait for sales, to hunt for discounts. This mentality serves us well in daily life, but becomes a liability in the market. The revelation that transformed Livermore's trading journey was this: cheap stocks are usually cheap for very good reasons. When you see a stock trading at low levels, what you're really witnessing is a battlefield where selling pressure has overwhelmed buying demand. The price is telling you a story that more people want to exit than enter. That's not a bargain, it's a warning. This perspective requires a complete mindset shift. The amateur is drawn to the stock that's fallen 50%, seeing only how far it is from its previous high. It's bound to bounce back, they reason, but the professional sees the same chart and recognizes the overwhelming force pushing the stock downward. They understand that betting against this momentum is like swimming against a powerful current, exhausting and often futile. Behind the scenes of every price movement is this invisible battle between buyers and sellers. The professional speculator becomes fluent in this language of supply and demand. They've trained themselves to see strength as opportunity and weakness as danger, the exact opposite of the untrained eye. But even with this knowledge, the master speculator never rushes in with full conviction. This brings us to another crucial element of Livermore's methodology: the art of the exploratory probe. Even when all signs point to a powerful emerging trend, discipline demands caution. When a leading stock in a strong industry breaks into new high ground on increasing volume, the professional doesn't immediately deploy their entire capital. Instead, they make a strategic decision to test the waters first. They might commit just a fifth or quarter of their intended position, enough to establish a presence, but not so much that a reversal would be devastating. This initial position serves as a scientific experiment. It's a question asked directly to the market: is my analysis correct? The beauty of this approach is that it removes the emotional burden of being all in from the very beginning. Your ego isn't fully committed yet. You can observe the market's response with greater objectivity. The impact of this methodical approach is profound. By starting small, you create space for the market to validate your judgment before escalating your commitment. This is the essence of risk management, not avoiding risk entirely, but engaging with it in a controlled, deliberate manner. Think of it as a reconnaissance mission before committing your main forces. You're gathering intelligence, testing defenses, and ensuring that conditions on the ground match your strategic assessment. Only when the initial probe proves successful do you begin to deploy your reserves. This approach transforms how you experience the inevitable uncertainty of the market. Instead of anxiety about being right or wrong, you develop the patience of a scientist waiting for experimental results. The market will tell you what you need to know through its response to your initial position. All you need to do is listen and observe with clarity. Now let me show you exactly what happens after this initial position is established and how Livermore used the market's own behavior to guide his next decisions. If you've ever made the mistake of going all in too early, type probe first in the comments below. Once you've placed your initial probe position, the next phase of this journey requires something rare in trading: patience combined with decisive action. This is where most traders falter, in that crucial moment when the market delivers its verdict on your analysis. Livermore understood a profound truth that transforms your relationship with the market. The only real validation of a trade is profit, not hope, not theory, not what some guru predicted, just cold, hard price action in your favor. When you enter a position at a pivotal breakout point, the market should confirm your judgment almost immediately. This immediate profit isn't just about making money. It's the market's way of communicating with you. It's telling you that your analysis was correct, that the breakout was genuine, that the trend is real. This validation is worth far more than the small financial gain it represents. It's confirmation that you're in harmony with the market's own rhythm and direction. But the revelation that separates professionals from amateurs comes in how they handle the opposite scenario. What if the market doesn't validate your position? What if the stock hesitates after your purchase and then falls below your entry price? The amateur mind creates a narrative. It's just a shakeout before the real move. The big players are trying to scare weak hands. I'll average down and improve my position. These stories feel comforting but lead to disaster. The professional's mindset couldn't be more different. They see the market's failure to produce an immediate profit as a clear and unambiguous message. Your timing was wrong. There's no argument, no second guessing, no hoping for a reversal. When the market speaks, Livermore listened. This is where the brilliance of his risk management framework becomes evident. If that initial position moves against you, you exit immediately, taking a small, calculated loss. The beauty of this approach is that your initial bet was deliberately small, perhaps just 20% of your intended position. The inevitable loss becomes inconsequential to your overall capital. Think about the psychological freedom this creates. You've paid a small fee to test a potentially major market move. If you're wrong, the cost is minimal. You preserve your capital and your emotional equilibrium. If you're right, you've established the beachhead for a much larger campaign. Behind this approach lies a profound truth about successful trading. It's not about avoiding losses entirely, but about making them small and manageable when they occur. The professional speculator knows that being wrong is an inevitable part of the game. What matters is how quickly you recognize and respond to being wrong. This creates a powerful shift in your trading psychology. You no longer fear being wrong because you've built that possibility into your strategy from the beginning. Your ego isn't wrapped up in each trade. You become a detached observer of market action rather than an emotional participant. Imagine the clarity this brings to your decision-making. There's no agonizing over when to exit a losing position. No hoping for reversals, no averaging down into weakness. The decision has been pre-made, systematized, removed from the realm of emotion altogether. Now, let's explore what happens when the market does validate your initial position. When that first probe starts showing a profit and you begin the next phase of building your line. If you've ever held onto a losing position, hoping for a comeback, instead of cutting your losses, type "accept the verdict" in the comments. When the market has validated your initial position by showing you a profit, you enter the most powerful phase of Livermore's methodology, the art of building your pyramid. This is where the true revelation of his approach comes to life, and it runs counter to everything most traders have been taught. After establishing your beachhead with that first successful probe, it's time to deploy the second portion of your intended position. But here's the watershed moment that separates masters from amateurs. This second purchase must be made at a higher price than your first one. The transformation in your thinking required here is profound. The amateur, if adding to a position, always waits for a dip or a pullback. They're constantly trying to improve their average price. But Livermore recognized this as a dangerous illusion. A dip might not be a temporary pause in an uptrend. It could be the first signal that the trend is changing. Instead, he embraced a counterintuitive truth: buying on a scale up. The rising price itself becomes verification that your analysis remains correct. It's the market's ongoing confirmation that the path of least resistance continues to be upward. You're not chasing the price. You're following the path of proven strength. Subscribe now to access more deep dives into the psychology and strategies of legendary market operators like Livermore, knowledge that can transform your trading approach. Behind this philosophy lies a deeper insight into market psychology. Price momentum tends to persist. Strength begets strength. By requiring a higher price for your second purchase, you're ensuring that you only increase your commitment when the market has proven, through its own action, that your original judgment was sound. This journey continues methodically as the trend unfolds. If the stock maintains its upward trajectory, you add your third portion, then your fourth, always at higher prices, always on strength. Each new addition is made only after the previous one has been validated by further price increases. The brilliance of this systematic approach is that your position grows in direct proportion to the market's validation of your thesis. You're not betting on hope or predictions. You're responding to what is actually happening right before your eyes. This is the essence of evidence-based trading. Consider the psychological impact of this method. With each addition at a higher price, your confidence grows not because of wishful thinking, but because of accumulated evidence. Your average cost rises with each purchase, but your conviction rises even faster because it's backed by the market's own action. This methodical reinforcement of success is how a small initial win is transformed into a potentially life-altering fortune. It's not through a single brilliant bet or a lucky guess. It's through the patient, disciplined process of systematically increasing your commitment to a proven winner. Think of it as similar to backing a championship team. You don't place your largest bet before they've played a single game. You might make a small wager at the start of the season. Then, as they win more games and prove their skill, you gradually increase your stake. By the time they reach the finals, you've built a substantial position, all validated by their consistent performance. The hidden power of this approach is that it removes the burden of prediction. You don't need to know how high the stock will ultimately go. You simply need to follow the evidence step by step, building your line as the market confirms your judgment, always ready to stop adding when that confirmation ceases. Let's now explore the extraordinary courage this strategy requires. A form of bravery that seems almost unnatural to the untrained trader. If you're ready to break the habit of waiting for dips and start buying strength instead, Type "scale up" in the comments. The journey to trading mastery requires a form of courage that feels almost unnatural to most people. When a stock you own is rising steadily, breaking through to new highs, a primal fear begins to surface. "It can't go much higher," whispers a voice in your mind. "Take your profits while you can." This fear of heights, this vertigo that comes from watching paper profits accumulate, is one of the most powerful psychological barriers to wealth creation. Livermore's revelation was understanding that this fear is the very thing that keeps most traders from achieving extraordinary results. The amateur snatches small profits at the first sign of success, content with a few quick points. But the master speculator has trained himself to resist this powerful instinct. He understands a profound truth. The life-altering money, the kind that creates generational wealth, is not made in those first tentative points of a move. It's made in the great, quiet, sustained middle of a major trend. Think about the transformation in mindset this requires. While others are congratulating themselves on a quick 10% gain, the professional is just beginning to build his position. He sees that initial move not as the end goal, but merely as confirmation that the real opportunity is now unfolding. This perspective shift changes everything about how you engage with the market. Behind the scenes of every great market fortune is this ability to stay with a winning position far longer than feels comfortable. It's the discipline to keep adding as the trend proves itself, to let the evidence of the tape overrule the fear in your mind. This is why true trading success is ultimately a triumph over your own psychology more than anything else. But this aggressive offensive strategy, this courage to build larger and larger positions as a stock advances, would be recklessly dangerous without an equally brilliant defensive framework. This is where Livermore's genius truly shines through. The science of the progressive stop-loss. The revelation here is that the stop-loss isn't merely a tool for limiting damage on losing trades. In the hands of a master, it becomes a dynamic, intelligent mechanism for protecting accumulated paper profits, for ensuring that a winning position doesn't turn into a losing one through carelessness or hope. Most traders understand the concept of a stop-loss in its simplest form, a predetermined exit point if a trade goes against you. But the professional speculator uses it in a far more sophisticated way. As the position grows and profits accumulate, the stop-loss evolves with it, moving higher in a systematic, disciplined manner. This creates an extraordinary balance of risk and reward. The offensive strategy of pyramiding allows for potentially unlimited gains as you add to your position. The defensive strategy of the progressive stop ensures that those gains, once achieved, can't be completely erased by a sudden reversal. Think of this dual approach as similar to climbing a mountain with proper safety equipment. As you ascend higher, reaching new altitudes, you constantly secure your position by anchoring safety lines at each new level. You're free to continue climbing upward, but you've protected yourself from a catastrophic fall back to the bottom. Without this defensive discipline, even the most brilliant offensive strategy will eventually fail. Paper profits are ephemeral things, promises from the market rather than actual payments. The progressive stop-loss is what converts those promises into reality. Let me now explain exactly how Livermore implemented this protective system in practice and how it allowed him to sleep soundly at night despite holding enormous positions. If you've ever watched paper profits disappear because you didn't have a proper exit strategy, type "protect profits" in the comments. The revelation that transforms a good trader into a great one is understanding the ephemeral nature of paper profits. That number you see on your screen, the unrealized gain that makes you feel so clever, is nothing more than a promise from the market. And the market is notorious for breaking its promises. Professional speculators like Livermore operated with a deep awareness of this truth. A paper profit isn't real money until it has been safely converted into cold, hard cash in your account. This isn't just semantic wordplay, it's a profound shift in how you perceive your positions and manage your risk. The amateur becomes mesmerized by watching their paper fortune grow. They check their positions constantly, calculating their theoretical wealth, planning how they'll spend it. This emotional attachment creates a dangerous blindness to changing market conditions. They forget that the market can take back in days what it has given over months. Behind the scenes of many trading disasters is this fundamental misunderstanding of what a paper profit really represents. It's not yours yet. It's merely on loan from the market, and that loan can be called in at any moment without warning or mercy. This is why Livermore developed a scientific and systematic approach to protecting these accumulated gains. A blueprint so precise and mechanical that it removed all guesswork and emotion from the process. The journey from theoretical wealth to actual wealth follows a clear path in his methodology. Here's the transformative insight. After your initial position shows a profit and you've made your second purchase at a higher price, your very next action isn't offensive but defensive. You immediately place a stop-loss order for your entire position at your initial entry price. Consider the mathematical elegance of this move. Let's say you bought your first lot at $50, and after it showed a profit, you bought your second lot at $55. By placing a stop-loss for both lots at $50, you've created a position of nearly zero risk. If the market suddenly reverses and hits your stop at $50, what happens? Your first lot is sold at break-even, a scratch. Your second lot is sold for a small, calculated 5-point loss. The total cost of the entire operation, if it fails at this stage, is just a minor and entirely manageable loss on only the second portion of your stock. The psychological impact of this approach is profound. You've taken a speculative position in what might be a major market move, but you've structured it so that your original capital remains almost entirely protected. You've effectively created an asymmetric bet, one where your potential upside far outweighs your potential downside. This is the essence of professional risk management. The amateur focuses solely on potential gains. The professional designs a strategy that addresses both potential gains and potential losses from the very beginning. They understand that protecting capital is their first duty, because without capital, there can be no future campaigns. Now, imagine what happens as the position continues to develop favorably. As the stock rises further and you add additional portions, the stop-loss evolves with it, creating an ever stronger defensive perimeter around your growing position. If you've ever experienced the pain of watching a winning trade turn into a loser, type "paper isn't real" in the comments. As your position continues to grow and the trend unfolds, the true brilliance of Livermore's defensive system reveals itself through the progressive stop-loss strategy. Let's explore what happens next in this journey. Imagine your stock has continued its upward movement. You've now added a third purchase at 60, building your pyramid methodically as the market validates your judgment. The transformation in your risk management now takes another step forward. You move your stop-loss for the entire position up to $55, your previous purchase price. This shift in your defensive perimeter creates an extraordinary mathematical reality. If the market reverses now and hits your stop at $55, your first lot bought at $50 is sold for a 5-point profit. Your second lot bought at $55 breaks even, a scratch. And your third lot bought at $60 is sold for a 5-point loss. The entire operation, if it ends at this stage, results in a net zero outcome, save for commissions. The revelation in this approach is that the trade itself is financing its own protection. You're systematically locking in the gains on your earlier purchases while only ever risking the paper profits from your most recent ones. This creates a position that becomes increasingly bulletproof as it develops, a stark contrast to how most traders operate. Behind the scenes of this methodology is a profound insight into market psychology. As a position grows more profitable, the tendency for most traders is to become less disciplined, not more. They loosen their risk parameters, believing the market has somehow granted them special status. The professional does exactly the opposite, tightening their defensive framework precisely when things are going well. This progressive stop is not a mental note or a vague intention. It's a hard physical order placed with your broker. It exists outside your moment-to-moment emotions. It's not subject to revision in a moment of hope or fear. It stands as an unemotional mathematical governor on the entire operation. The journey to mastery ultimately comes down to one core truth: discipline is everything. The method Livermore developed is perfect in its logic and has been proven through decades of market operations. But it remains just a tool. And like any tool, it is useless in the hands of someone who lacks the discipline to use it correctly and consistently. The market is the ultimate teacher of this lesson. It ruthlessly punishes those who seek exceptions to the rules, who believe their situation is somehow special, who think that this time the stop loss can be ignored or moved lower just this once. The tuition for these lessons is often paid in devastating losses. What separates the consistently successful speculator from the amateur is not intelligence, not access to information, not even the quality of their analysis. It's their conquest of self. The professional has achieved victory not over the market but over the powerful, primitive, and eternally costly human emotions of greed, fear, and hope. This inner triumph is what allows them to replace emotional reactions with the cool, calm, and profitable logic of a definite scientific plan. They've transformed their trading from a series of anxiety-ridden guesses into a methodical campaign with clear rules for both offense and defense. The challenge for most traders isn't understanding this method, it's implementing it with unwavering consistency. Every trader knows they should cut losses and let profits run. But knowing and doing are separated by the vast chasm of emotional discipline. If you recognize that your greatest battle is with your own psychology rather than the market, type "inner victory" in the comments. This journey we've explored together, Livermore's method for turning small wins into fortunes, isn't just market history. It's a timeless blueprint that remains as powerful today as it was a century ago. The market's language hasn't changed, even if the technology around it has. What I find most fascinating about this approach is how it transforms trading from a series of random bets into a structured scientific campaign. It replaces hope with evidence, emotion with method, and guesswork with a proven system. If you found value in uncovering these principles with me today, consider subscribing to the channel. Each week, we dive deep into these timeless market truths, the kind that aren't taught in typical trading courses, but make all the difference between consistent success and perpetual struggle. I'd love to know you made it to the end of our exploration. Drop a comment with the words "scientific speculator" so I'll know you're putting these principles into practice. And if this perspective has shifted your thinking about how you approach the markets, a like on this video helps others discover these same insights. The psychological discipline we've discussed today is just one piece of the trading mastery puzzle. There's a video right here about the specific chart patterns. Livermore used to identify his pivotal points, those precise moments when he would initiate his campaigns. Click and continue with me over there as we build your complete trading framework, one principle at a time. Until next time, remember, the greatest victory isn't over the market, but over yourself.